What if you could steal the 2026 market playbook in just 10 minutes? Today we've done something most investors don't have time to do. We've read everything. The 2026 outlooks from the world's biggest players: JP Morgan, Morgan Stanley, Bank of America, Amundi, Fidelity, HSBC, BNP, Northern Trust, all of them. And here's the surprise. They don't see chaos. They see controlled disorder. A world where AI-driven growth is powerful, almost unstoppable, but where inflation, debt, geopolitics, and fragmentation make the market more fragile than it looks. So in this episode, we give you the ultimate shortcut, where the real growth is, why passive investing is breaking down, and the 5 actionable convictions global institutions are quietly aligning on for 2026. No noise, no hype, just synthesis. If this brings you value, share it, like, subscribe, and stay tuned for more content like this. The podcast starts now.
Welcome to the Deep Dive. Today we're on a critical mission to synthesize the most influential 2026 global market outlooks. We've gone through research from, well, basically everyone who matters. Northern Trust, Amundi, JP Morgan Private Bank, Morgan Stanley, Fidelity, HSBC, BNP Paribas, and the Bank of America CIO. And our job is to give you the ultimate shortcut for the year ahead. What's amazing is the central tension you see in all these reports. Northern Trust, for example, calls it resiliency with complexity. Amundi is a bit more blunt. They just call it controlled disorder.
That's the perfect phrase, really, because the story for 2026 is this massive tug-of-war. On one side, you have this incredible, almost baked-in growth from the AI cycle. I mean, massive capital spending is driving really strong returns. But on the other side, the foundation has some serious cracks. We're talking about structural inflation, deep geopolitical fragmentation, and just the sheer weight of global debt.
So a resilient market that's also fundamentally fragile. That's what we're going to unpack today. We'll look at where the growth is, how the regions diverge, and most importantly, the 5 most actionable pieces of advice these institutions are giving you right now. So let's start with the good news, the global consensus. The baseline outlook is surprisingly robust. Most of these sources, JP Morgan, Fidelity, Northern Trust, they all see global stock gains continuing. And this is supported by that AI push and, of course, the expectation of falling rates.
Right. Amundi is even projecting global GDP growth to moderate just a bit, but hold firm at a very resilient 3%.
So the cycle continues, but it feels like it's limping a little.
Limping is a great word for it, because that resilience is very, very selective. And if the growth is that uneven, the sources all agree on one thing. The old set it and forget it's passive strategy of the last decade is basically over.
Okay, let's unpack that. Why is just tracking the index, passive beta giving way to active selection?
Because the rising tide isn't lifting all the boats equally anymore. Northern Trust, in particular, points out that the defining feature of 2026 will be these increasing divergences within asset classes.
Meaning what exactly?
Well, think about U.S. stocks. The correlations between them are lower now. When correlation is high, if the S&P 500 goes up, most stocks go up with it. Pretty simple. But when correlation is low, some stocks can soar while others just sink. And that means you need managers who can actually distinguish between the winners and the losers. You have to hunt for real alpha.
So it's no longer good enough to just own the market. You have to know exactly what you own. And that whole headache is amplified by the sheer force of the AI engine, right?
Absolutely.
Right.
AI has moved from a buzzword to, a primary economic driver. BNP Paribas confirms the rally is grounded in robust earnings, not just speculative hype. This is real CapEx in action.
And companies are being forced to invest.
They have to. Fidelity expects U.S. tech earnings to keep growing robustly for exactly that reason. The money is moving from talk to tangible hardware.
What's really interesting, though, and Amundi, HSBC, and JP Morgan all point this out, is that the opportunity is broadening. It's not just about a handful of U.S. mega caps anymore.
Yes, the theme is flowing outward. It's expanding into infrastructure, so think data centers, transmission grids, and also into industrials and the green transition companies that are needed to power all this new tech. It's a societal remodel, really, driven by silicon.
Okay, let's dive into the regions, because this is where that divergence becomes so critical for your portfolio. Let's start with the U.S. The theme is exceptionalism, but it's definitely being tested. Morgan Stanley, Fidelity, Bank of America, they all seem to agree the bull market is intact, driven by that AI investment and resilient high-income consumers.
It's strong, but it's precarious. The big structural challenge for the U.S. in 2026 is without a doubt the inflation problem. Amundi and HSBC see U.S. inflation remaining higher for longer. It'll probably hover stubbornly around 3%, which is still above the Fed's target.
And the debt.
And the debt. Amundi and Fidelity warned that the record levels of public debt add this whole other layer of geopolitical risk. It puts real pressure on the Fed's independence.
So even though Morgan Stanley projects the S&P 500 could gain 14%, which is a fantastic return, Bank of America points out the catch: valuations are tight.
Very tight. The price-to-earnings ratio is already well above its 5- and 10-year averages. So what that means is any gains are completely dependent on perfect, continuous earnings delivery. No room for error.
And what about the bond market?
BNP Paribas flags U.S. fixed income as vulnerable. It's because of that risk of terrorist-induced inflation and, again, the ongoing fiscal deficit issues. The U.S. leads in growth, but it's also carrying the most baggage.
Okay, let's shift across the Atlantic to Europe and the UK. The story there is completely different. It's all about value.
Compelling value. BNP Paribas and Morgan Stanley both note that European equities are trading at a significant discount compared to their U.S. peers. And the core theme in Europe now is strategic autonomy.
Strategic autonomy, what does that actually translate to for an investor?
It translates into two massive investable trends. The first one is defense. With new NATO targets calling for spending up to 3.5% of GDP, and you have the EU's proposed €800 billion rearm Europe plan. This is a genuine defense supercycle taking off.
But the advice isn't just buy defense stocks, is it?
Not at all. European fixed income is actually a key call, especially from Amundi.
Why is that?
Because the ECB, the European Central Bank, is expected to cut rates even further. Amundi and BNP think they could go down to 1.5% by mid-2026.
Okay.
And that easing really favors European bonds, particularly peripheral bonds from places like Italy or Spain, where the yields look attractive.
So for stocks, the focus is on small and mid-caps, financials, industrials, and for the UK specifically.
For the UK, BNP Paribas sees gilts. That's just UK government bonds offering really attractive potential returns. That's driven by lower inflation expectations and a tighter fiscal policy compared to the US, a much more disciplined picture.
Moving quickly over to Asia, Japan seems to have a new driver, a shift to a more supportive fiscal stance.
Yes, under the new prime minister. Amundi notes that this prioritizes growth after years and years of stagnation. And this fiscal push is forcing monetary changes. They actually expect the Bank of Japan to hike rates twice.
And China, the story there is a bit more complicated.
It is. Growth is expected to moderate to below 4% by 2027, according to BNP. Policy is now laser-focused on internal innovation, on that same strategic autonomy idea, investing in what they call new productive forces.
And you can see it in the markets. We have to mention the China Tech 8 stocks. They surged roughly 34% year-to-date through October 2025. That's a huge number.
It shows exactly where the money is flowing. Domestic tech. And remember, Amundi points out that China's dominance in critical minerals is this massive geopolitical lever. They control something like 90% of rare earth processing. So their internal focus is absolutely vital.
All right, that brings us to the most important part for you, the listener. What do you actually do with all this? We've pulled 5 key convictions that just keep appearing across all this research.
Okay, conviction number 1. Prioritize active selection over passive beta. Given everything we've talked about, the fragmentation, the low correlation Northern Trust is very clear on this. You need to move from broad index funds to high-quality, value-oriented, truly active strategies if you want to capture alpha.
Okay, active over passive. What's number 2?
Number 2, diversify fixed income away from treasuries. JP Morgan and Northern Trust are worried about what they call the sheer weight of U.S. deficits and debt. All that pressure could weaken the dollar.
So don't put all your bond eggs in the U.S. basket.
Exactly. Look for global government bonds and investment-grade credit elsewhere. Amundi echoes that point very strongly.
Makes sense. Number 3.
Third is, use TIPS as an inflation hedge. TIPS are Treasury inflation-protected securities. Northern Trust highlights a really interesting opportunity here. The market's expectation for long-term inflation is actually lower than the 3% inflation we're seeing right now. That suggests TIPS might be priced attractively for long-term protection against that sticky inflation we mentioned.
Okay, so tactical play on inflation. What's 4th?
4th, target AI infrastructure and real assets. This is a secular trend, not a fad. Infrastructure, those data centers, the transmission grids, and things like private credit are positioned to benefit directly from these long-term investment cycles. Northern Trust, Amundi, JP Morgan, they all see these as offering resilience and an effective inflation hedge.
And the final conviction.
And number 5, hedge against dollar weakness and uncertainty. With all the U.S. deficit spending, Amundi and HSBC are really pushing structural hedges. They specifically call out gold, which is supported by central bank buying, and selected currencies like the Japanese yen and the euro, as the dollar is expected to weaken over the outlook period.
Okay, we've covered the consensus, the regions, the strategies. Now for the final crucial step. What could blow this all up? If the outlook is resilient, what are the 5 primary threats that could shatter this controlled disorder?
The risks are systemic. And number 1 is structural inflation and fiscal dominance. JP Morgan and Amundi argue that inflation is just fundamentally shifting. You have reshoring, energy transition costs, huge deficits. It's all inflationary by nature.
Right.
And Fidelity has a huge warning here. If the Fed cuts rates while inflation is still stubborn and U.S. debt is so high, it risks damaging central bank credibility. That could lead to a very sharp, very painful steepening of the yield curve.
And that would be bad for just about everything.
Everything. Risk number 2 is geopolitical fragmentation and trade turbulence. We're in a global realignment. JP Morgan stresses this shift away from pure globalization. Northern Trust warns that continuous U.S. trade restrictions are forcing global supply chains to either move, absorb the costs, or
just pass them on to consumers, which feeds back into that inflation problem.
Precisely. It's a vicious cycle.
Okay, what about the risk tied directly to the AI engine itself?
That's number 3. AI concentration and the ROI challenge. The rally relies on very narrow leadership. The big challenge for both the developers and the companies adopting AI is proving a return on their enormous upfront investments. Both Northern Trust and JP Morgan warn about the risk of overbuilding infrastructure and, well, these circular investments among hardware suppliers.
Like they're all just selling chips to each other.
It can start to look that way. Number 4 is a fascinating one. The disconnect between policy uncertainty and market volatility. Fidelity points this out. We have historically high economic policy uncertainty because of geopolitics, but market volatility. The VIX is surprisingly low.
The market is calm, but the world isn't.
Exactly. The market seems to be underpricing risk, and that gap has to close eventually, probably through a spike in volatility in 2026.
And the final risk?
Number 5, credit vulnerability in the U.S. Credit fundamentals are set to weaken, especially for highly levered small-cap U.S. companies, according to Northern Trust. Amundi is also very cautious on U.S. high-yield bonds because of their exposure to regional banks and their dependency on the financially weaker consumer.
So what does this all mean for you? The core takeaway for 2026 seems pretty clear. It's less about finding growth AI is providing that, and much, much more about navigating this unprecedented complexity and divergence. The era of easy passive gains is over.
I think the deeper implication, the thing that should really stick with you, is how national security is now driving profitability. You have this huge energy demand from AI, combined with what Bank of America calls the security supercycle, that global defense and strategic build-out. It means that things like infrastructure and critical materials, they're not just cyclical plays anymore. They are now fundamental security assets. Geopolitics and corporate profit margins are now permanently intertwined.
Selection, vigilance, and understanding that geopolitical map are your new core assets. Thank you for diving deep with us.
Still here? Thanks for staying with us and for taking the time to think through the 2026 outlook with AI Wall Street Talk. If this synthesis helped you see the markets more clearly, share it with someone who should hear it. Like and subscribe for more AI-powered market insights. More analysis is coming. Stay tuned.